Hey folks, and welcome back to my channel. My name is Dan Fria, and I do the rate update every morning to keep you guys informed what the heck's going on in the markets. And specifically what we try to do on this channel is give you the whys behind everything. Why is the stock market going up? Why did Bitcoin it was up $1,000 just in the last 24 hours? Those are things we talk about at 3 o'clock. But in my morning video, I try to bring you up to speed on what's going on in the economy that'll affect real estate, mortgage rates, and mortgage programs, and so forth. So today I want to go over what's going on with the money supply, believe it or not. So before you turn the dial, what we're going to talk about today is I'm going to explain to you how inflation works, why it's a concern, and I have bigger concerns that I'm going to show you at the end of the video because consumer debt is spiking rapidly, and that's a huge concern nobody's talking about. So without further ado, let's get over to what we're talking about. So what you're seeing on your screen right now is what I see on one of my screens on a daily basis. I follow the bond market. Why do you ask? Do I follow the bond market? Because that is where mortgage rates are produced. So I follow mortgage rates to see, give guidance on what's going on with that, as well as mortgage programs and everything else. So what you're seeing on your screen right now are the treasury yields, as well as the MBS, mortgage-backed security market prices. So a little confusing here. But let me go through this real quick with you, and then we're going to get to some juicy stuff. So we got the 10-year treasury right now is up 0.01. Nothing really there. But what's concerning right now is the MBS market. It is up the MBS 6.0. That's the one I follow because it's closely related to today's yields, is down 20 basis points. What that means is rates are going to go up. They're going to go up probably about 0.05 to 0.08 to open the day. And so that's basically what this triggers are telling us. But I want to go into some context. You're seeing down through here is the Federal Reserve is saying that they want the unemployment rate to spike and other things. But I have more concerning things to talk about this morning. Let's get over to see what data that we're going to watch for this week that has the most important value to us because it's the most important to the Fed. So let's get over to it. We have on Tuesday, we have the short-term energy outlook. Not really going to pay attention to that. But now here's where the juicy stuff comes in. And I'm going to explain this in this video in detail to you. What is the CPI? Because you see the numbers here and it says the core CPI and CPI month over month and CPI year over year. And then you have PPI. What are all these numbers? Why should we be concerned? Well, it's basically comes down to the inflation, okay? The C or the core CPI means consumer price index. PPI is producer price index. So easily this is explained by this is the consumer inflation, okay? But I'm going to dig in a little bit more on that. So the first thing is we want to talk about is what exactly is inflation? So you guys might say, well, we don't know. We just all watch these charts every day, and we know it's a concern because the news tells us it's a concern. Well, let's get over to this and really dissect what is inflation. It's basically the erosion of value of the dollar. Okay, so the dollar today, like when I was a kid, you could go and get a Big Mac for 25 cents. What is it today? $5. That's basically inflation, okay? The price of the dollar. Well, let's look at it this way. The value of the dollar going down or the prices of things going up. But let's read its definition. What is inflation? Inflation is overall increase in the price of goods and services in the economy. Over time, currency loses its value and doesn't have much of purchasing power as it once did. In other words, I'm going to move my head a little bit. Whatever a dollar can buy is reduced over time. Inflation can occur for a variety of reasons like higher wages, which we're seeing, lower interest rates, which we saw, supply chain issues, which we saw, and or broader issues in the global economy. All right, so how is inflation measured? I'm just going to take you to this portion. There are many ways to measure inflation, but one of the most common measures is the Consumer Price Index. The price index for urban consumers. So the CPI, the Consumer Price Index, which is produced by the Bureau of Labor Statistics. The CPI-U shows the change in prices paid by urban consumers for a representative basket of goods and services, or the most common goods and services purchased on an average monthly basis. You were asking, why am I moving my head? So you guys can follow along with me. Okay, so basically that's what we talk about. Remember I said it's a basket of goods and services they stamp a price tag on at one date. And then in the future, it could be the next month, it could be the next year, or so forth. They figure out what the value of that basket of goods is at that point, and then what is the difference? Did it go up? That means inflation's going up. Did it go down? That's deflation. So that's what we're really talking about. So the CPI right now, here's just some numbers for you to look over. The latest CPI numbers came in at 6.4%. You can see it right on your screen. But then you see some other things. They strip out CPI all items less food and energy. So if you go back to this piece right here, you're going to see right here, the core CPI. Okay, that means they stripped out food and energy. So let's go back to this piece of it. So we got that. If you CPI average medical care, okay, then they break it down per context. So we got 2% there, overall 5.8. So right now we got about a 6.6% inflation rate. Now let's really dig into this. Okay, so you read on this, if you have excess monies or the deflation of the dollar or too less goods and services because supply chain issues and so forth. Well, let's get over to the money supply, the M2 money supply. Here's where a lot of people don't talk about. I'm not going to dig real deep because I want this to make sense just in common sense. The M2 money supply is basically this. And there's a reason why I'm telling you. M2 is the U.S. Federal Reserve's estimate of the total money supply included of all the cash people have on hand, plus all the deposits they have in checking accounts, savings accounts, short-term investments like CDs and so forth. So what it means is how much money we as a consumer, we as the U.S. citizens have in the bank. Okay, so let's go over to here. Here's where, I show you this chart all the time. So here's where the consumer disposable income comes into play. And this is from the Federal Reserve. All right, so here's how much money people had or consumers had throughout the years when it comes to disposable income. How much money you have after you pay all your bills. So I'll get my head out of the way. And here's the chart. You see every year it goes up and up and up. Then there's an anomaly right here, right through here. Well, what happened in 2019, 2020? Well, the world shut down. So everybody was forced to not work unless you were an essential worker, stay at home. So how in the world did we see the consumer disposable income spike to the highest levels we've ever seen in history? Okay, and I can go back and change this to any term you want. Look at it. So here's it is in a little bit of a close-up view. We went from about, 15,000 to almost $20,000, okay? So why is this a concern, you might ask? Well, here's the M2 money supply. Here's how much money was in circulation back last year. Look how much this was, okay? Here's how much money came out of that. Remember what this is. What is this? Well, it's basically my apologies, is right here. Includes all the cash people on hand, have hands, checking, savings, and CDs, and so forth, okay? So this is telling us people had a ton of money. Go over here, people had a ton of money, and what's happening? It's depleting and depleting and depleting fast. But here's the concerning part that I have. When you go over it here, here's the total debt. Okay, this is from the Federal Reserve of New York. This is how much debt people have. Here's the thing I want you to focus in on. Remember back in 2020 when people got all that money? Look at non-household debt. It was 4.2 trillion. It usually gradually increases over time. Okay, go through here. People were spending. And then we hit the pandemic. And then look, there was 4.2 trillion in 2020, Q1. Then we go to Q2, 4.1. And we go further, 4.12, 4.17. So we stagnated right through here during that time, and then all of a sudden it just spiked. Okay, so people have way more debt, consumer debt, than they had in probably history. So they have way too much debt here. Their savings accounts are depleting, as shown there on the M2 money supply, as well as consumer disposable income. So my concern, well, you've be seeing my concern. My concern is this. People were flushed with money during the pandemic, as we know, okay? And that's proven right here, okay? So what happened? People's spending habits they were spending and spending and spending and spending. So we even spent all the way through the pandemic. Okay. And people had extra money because you couldn't go out to dinner. You couldn't really go out and do anything, spend your money any other way on services. So you had to spend it on goods. All right. So now the unfortunate part is people now keep spending their same habits, but they don't have the money in the bank. So what are they doing? They're charging it. Okay. So here's when I'm going to round this out is my thoughts now is the unemployment rate or employment numbers I think people are going to be forced to go back to work because they're running out of money. So when you start hearing the government in the news channels saying, the unemployment rate's going to spike and all this other stuff, guys, that isn't good news for any of us because that means people are running out of money here. What you're seeing, they're going back to work, but now we're coming into a recession. And they're saying, well, a lot of manufacturers, a lot of companies don't need that work now. So what's going to happen? It's not good news right now. So we need the economy to change. We need people to go back to work. I'm thinking we might have a soft landing. Here's what we're going to see. We're going to see some stagnation right now. We're going to see people being forced back in the workplace, being forced back into getting on their regular budget that they've been in, they used to be on, because they only had a finite amount of money to use and so much credit. Credit is going to start getting halted because the Federal Reserve is tightening credit policies. So there's going to be some hard pain for people all over the place. But the good news is people are getting forced back to work. So I'm expecting actually the employment numbers to basically be not as bad, that's good English, as the Fed and everybody keeps expecting things to be. So I know it was a little in depth today, guys, but I want you guys to understand inflation and all the background pieces of this. So you get it. You're like, okay, inflation, what caused it? Well, the war in Russia. No. This is exactly what happened. So why do you usually come in and follow my channel? Well, let's go over and see what's going on with mortgage rates. So I want to give you an idea where mortgage rates are, because I got a few calls yesterday from people that I helped buy years ago. And they're like, well, what's today's rate? And when I say 6.5, they basically fall off their chair. They're like, we bought 5 houses from you, and the highest rate we ever got on one of those was like 4.5. And I'm like, welcome to today's world. So here's what we're seeing in the market right now. Let's refresh the MBSs. We are down 20. That means we're probably going to get a rate increase of about 0.05 on rates. Okay, so what this means is what you're seeing on your screen is what's going on with the MBS, the mortgage-backed security bond trading on Wall Street. And this is what the price is, and this is what is happening currently to the price. If you want to see the live ticker, it's right here. We're down 11. So this is live. You might even see this trickle through. Okay, so what does that mean for rates? Well, here's where rates closed last night according to Mortgage News Daily. And I don't want to make this clear. These are not any bank's rates. Okay, this is just, if you watch the Dow, if you have stocks and you watch the Dow Jones or the NASDAQ and you see, oh, the NASDAQ's up today, well, most likely your stock's going to be up today. So if you see these rates going up, well, most likely if you're not locked in, your rate's going to go up probably in somewhat of accordance to these rates. So you can see you have rates here, the top 6 products people use from the 30-year fixed all the way down to the 30-year VA mortgages. So again, this is published by Mortgage News Daily. If you want this report sent to you guys each day, subscribe to it down below. But I would highly suggest subscribe to my news channel or my newsletter down below, because you're going to get this. You're going to get this, you're going to get daily reports, and you're going to get a bunch of things that help you guys make financial decisions in your life. So that's my report for today. Today on my 3 o'clock live, I'm going to take all your questions in regards to stocks, bonds, real estate, and crypto. Today, I did find some information about the FHA 40-year term loan, and I'm actually going to put a special video out today about that. It'll be out later this evening or first thing in the morning, because I want to be clear on what's going on at FHA with the mortgage programs that they have. So otherwise, guys, thank you so much for watching, and I'll see you at 3 o'clock today. For your guys, please, if you participate or you come to my live event, please be ready to ask a few questions, even if it's like, hey, Dan, how's your day going? So that's it for today, guys. Thank you so much for watching. I'll see you later this afternoon. Bye-bye.